Hello and welcome to Live Wire Markets. My name is Chris Conway. Today I'm having a conversation with three members of the Yarra Capital Management Equities team, Marcus Ryan, Joel Fleming and Michael Steele. They're going to be talking to me about the recent reporting season. Gents, here we are again after one of the most memorable reporting seasons in recent memory. There's so much to unpack, so we're going to dive right into it. Marcus, I'll come to you first. How would you characterise the season that's just gone?
Yeah, Chris, it was a really strong reporting season overall. However, sitting behind this was some really quite uneven performance across sectors. So over the month of February, the ASX 200 leapt a very impressive 4.1%. That was the strongest February, in fact, for 7 years. Takes the 12-month return for the ASX 200 to just over 16%. What we saw is about twice as many beats as misses. And importantly, we actually saw 3 times as many guidance upgrades compared to downgrades. Miners and banks really drove the strong market returns overall. In fact, they contributed over 100% of the market appreciation. And then you saw a multitude of sectors contribute to negative returns. So healthcare, IT, consumer discretionary, even the REITs. So overall, earnings estimates actually were revised up 2%. Looking out to F26, it takes the market EPS growth to now 12%, and that's up on the 5% expectation at the start of the fiscal year.
Marcus, you never disappoint. Some great stats in there. Well done. High bar set early. Michael and Joel, I'll ask you what have been the major themes. Michael, I'll come to you first.
A major theme during reporting season was AI, both AI disruption and also AI productivity opportunities. In terms of AI disruption, we saw a real step change in focus for the market on this disruption risk. You had developments like agentic AI, and that really focused people on the risk to businesses. So the market's concerned there'll be new competitors enter markets with AI at the centre of their businesses and potentially disrupt technology and also people service type businesses as well. And that's been a massive focus. But the market's been very indiscriminate in how they've sold off companies, and that's creating opportunities for us with some sold off opportunities emerging. From an AI productivity perspective, that was a massive focus as well. There was some noteworthy examples of companies materially reducing their headcount. It's clearly going to be an opportunity going forward to improve productivity for businesses.
Joel, AI is all that everyone's talking about, but what was another theme from the season for you?
I think it's the CapEx cycle that's starting to evolve, which is partially due to the AI thematic, as well as what we're starting to see in mining. You know, we talked before about, BHP doing a huge amount of heavy lifting this reporting season, but they're very profitable, they're generating a lot of cash, and we're starting to see those service providers really start to benefit. Big tailwind starting to emerge there. So I think early stages, but that was something that really stood out for me.
Yep. Michael, I'll throw it back to you. Highlight of the season.
Highlight of the season was the resources sector. You saw massive earnings growth there, in particular because of higher commodity prices, in particular across copper, gold and lithium. If you look at the small companies resources market, earnings are expected to increase by over 50% over the next 12 months. We have some hesitation around how sustainable that earnings growth is into future years, given headwinds around production volumes and high unit costs.
Marcus, I'll throw it back to you to round out this part of the segment. Low light of the season.
Low light of the season for us, Chris, would have been the healthcare sector. So it was the worst performing sector across the ASX over February, falling 13%. What we really saw here is competition, costs, regulatory risks really manifest. So we saw CSL falling 19% over the month. That stock now off 44% year over year. We also saw AI disruption impact some of the sort of healthcare tech names. Pro Medicus fell 29%. That stock's now halved year over year. Still trading on a 70 times PE multiple. And then we also saw just the affordability theme and the lack of demand impacting a number of names. Cochlear comes to mind. That stock was off 26% over the month. The one shining light, however, was Ramsay Healthcare. That stock rallied 18% over the month. Strong result, strong outlook.
Let's shift gears, gents. We'll talk about your respective cap spaces. So Marcus, we'll start with you towards the top end of the market, the very pointy end of the market, broad cap equities. Like you said in the opening, they really sort of carried the season. Banks and miners doing well. Is that, do you think, a sign of AI fears, people piling into the safer names? What's going on in that space?
Building on Michael's earlier comment as well, We saw actually for the miners and the banks, we actually just saw the fundamentals really quite strong. So both sectors were very well supported. What strikes us now is that these two sectors, however, make up 40% of the market cap on the ASX 200. We do start to think there's pockets of vulnerability there. So as a result of that, we're really searching for incremental opportunities outside of these spaces. So just for context, we saw the banks and we saw the miners rally 14% over the month. That's huge, compared to the market up 4%. And that was really driven by that strong earnings momentum. So for the banks, we actually saw earnings estimates rally about 4% to now be 9% year over year. So strong loan growth, resilient margins, good cost control, low bad and doubtful debts. So that sector's clearly, the fundamentals have clearly improved there. For the miners, we saw earnings actually inch up 3% there, really driven by strong commodity prices and good cost control. In conjunction with those earnings changes, we did see the multiples expand, and I do, to your point there around broader risks, I do think we can say that's associated to the fact that these sectors have less associated risk with AI disruption, as we discussed earlier, and even the domestic interest rate cycle. Banks today, however, they're trading at 60% PE premiums relative to the past. So we don't think this 9% earnings growth is going to be sustainable. Competition and costs will come in time. As a result, we're looking for opportunities outside of the banks within financials. Challenger is one name that comes to mind. So we like the outlook for annuity income products in general. We like Challenger's product portfolio they can roll out. Some credit spread normalisation, some capital management opportunity. The stock's trading on 13 times PE, so we really like that name. More broadly, we also see opportunities in the utilities and communication services space. Origin Energy would be a key name in the utility space. We think it'll be a beneficiary of the energy transition in Australia. You think of the three key businesses there, so energy markets, APLNG and Octopus. We think in aggregate the market's not just ascribing the value to those businesses, and as the cash flow improves, as they unlock value from Octopus, we think that'll be better recognised. Meanwhile, we're collecting a circa 5% fully franked dividend yield as we wait. And then lastly, Car Group in the communication services space. So look, we still think moving forward that stock can generate double-digit earnings growth. Stock's actually fallen 30% since late last year. It's trading on a really undemanding multiple of 22 times. We like this name. And just finally, from an AI perspective, we actually think this is the sort of name that AI can divert more traffic to its website rather than less.
Marcus, I was going to ask you for a couple of stocks and you gave us three, so we got a bonus one. So the viewers will be loving that. Michael, I'll come to you. Small caps outperformed large caps for a period, but as you told me when we spoke the other day, since the start of the year, they've actually underperformed. Where are we now in that whole outperformance, underperformance for small caps?
Our view is small caps can outperform going forward. In particular, that's supported by higher earnings growth outlook and also more attractive valuations. If you look at the earnings growth outlook for small caps, our view is it will be higher than large caps going forward. If you look at just the next 12 months, our view is small caps will have over 20% earnings growth. And you compare that to large caps have only got around 10% earnings growth. So you're getting at least 10% more earnings growth in small caps. There's a number of factors that support that. You're seeing improving economic growth, market share gains, margin expansion, seeing a lot of small caps putting capital to work in growth capital expenditure and also M&A. And the pleasing thing is it's quite broad-based, the level of earnings growth across industrials, financials and also resources as well. In terms of valuations are much more attractive in the small cap part of the market. They're trading at a 18% PE discount compared to large. And you look at it compared to historical levels, I've got a PE multiple of 15 times, which is really quite attractive when you compare it to the large caps, which are much more expensive. The one area where we could be wrong is if we have a major financial market correction or a major economic shock. You tend to see in those events the market moves back to the perceived safety of the large caps. So that's the key risk to that call around small caps outperforming.
Michael, I'm going to put you on the spot now. I was talking to Roy the other day, of course, co-head of fixed income here at Yarra, and he was talking to me about interest rates. And I think the house view was that we wouldn't get an interest rate hike. Interest rate hike doesn't help small caps all that much, does it?
We have spoken about interest rates in the past, and they have been associated with when you've got rates reducing, supporting small caps outperforming, and the inverse the other way. What I would highlight though is that it's not a one-dimensional thesis. There is really strong earnings growth, really attractive valuations, and our view is that there might be an individual headwind in interest rates, but there's other factors to offset that, and the economy is still in pretty good shape as well. So that's another thing to keep in mind, that small caps are more leveraged to that as well.
Very deftly handled, mate. A question on the spot. Well done. Give me a couple of stocks that you like in the small cap space at the moment.
Two stocks that stand out that had solid results and also have the potential to outperform going forward are Pinnacle Investment Management and also NetWealth. The big factor with both those stocks is they've got a significant market share opportunity, which underpins a growth outlook over the next 5+ years. So if you look at Pinnacle Investment Management, really large opportunity with the global platform they've now built. So they've got market share opportunities in Europe, Asia, and also the US. And then they've got the additional upside from adding new fund managers to the platform, given it is such a unique business model. In terms of NetWealth market share, large opportunities still in their core platform market. They've only got 9% market share currently, and then additional market share opportunities in superannuation and also the broker market. Both those businesses have got a sustainable cost base. They've invested significantly over recent years. They've got good balance sheets. They've effectively got founder-like mindsets in terms of running the businesses for the long term, and they've underperformed recently. They've come back to much more attractive levels from a valuation perspective.
Joel, let's talk micro caps. Talk to me about some of the big themes in your space through the season.
Well, I guess we're constantly reminded there are so many ways to win in microcaps, right? The spread of opportunities is huge. We can get very nuanced and selective exposure to themes that are working there. And look, things are changing pretty quickly. Like, I think the catch up on AI and how people are thinking about that today compared to 6 months ago is very, very different. So we're looking at lots of different opportunities, from those contractors that are helping to build these data centres, part of the electrification theme and all of those kind of things, as well as looking at interesting commodities, growth businesses that are bringing assets online and moving into production. And again, it's just, there's so many opportunities available to you. The liquidity is improving, there's a lot more capital raising activity occurring, and from those very dark times in post-COVID where that liquidity flowed out, it feels like investors are willing to start to look a bit further down, and that's really promising for the outlook for the sector.
Joel, last time we spoke, you were talking about the operating momentum that was existing in micro caps rather than the financial engineering or shenanigans that sometimes go on. Is that still the case, and you're still excited about it?
Absolutely. I mean, we're constantly looking for an inflection point, right? You invest in these cost bases and you've got to prepare for that revenue to come through. And we saw a couple of examples this reporting season where you really think they're hitting that really important point. So the cost base is sustainable, that revenue line starting to pick up, and you've got some real operating leverage, margin expansion coming through, good cash flow generation. And I mean, that's a sign of a business that's moving into being more sustainable, more durable. And again, as these industries are evolving and these companies are starting to take some good share there, I think people are starting to look, this is not a 1 or 2 year cycle, but potentially 3 to 5 years of outperformance here. And I'm potentially getting a future leader of this particular area. So we're really excited about that.
Let's take it from theory to practice, Joel. Give me a couple of names that you like.
Really like Energy One. So again, software. It's been sold off in the recent turmoil in that particular sector. But again, it's involved in the structural market that's changing. So think about the energy sector. Every time we look at grids and we've got more batteries, we've got more wind and solar coming in, this is the software that helps to sit behind that and actually manage this really complex area that's going through significant change. So it's pulled back a little bit. We think it's a fantastic business with a long-term growth runway. Good position here in Australia, really big opportunity in Europe, and we're really excited about that and think the current share price looks pretty interesting to us. And I guess the second one, Artrya, again, it's a software company, about early detection, non-invasive in coronary heart disease. So this kills more people than cancer. It's not something that really presents itself obviously, so being able to kind of get in front of the curve is incredibly important. They've ticked off a couple of important milestones with the FDA. There's some good momentum in the business there. We like the commercial model and the clients that they're starting to work with, and we think that this could go on to become a really well-positioned company, producing a product that has got a lot of optionality out there in the market.
Let's pivot again, gentlemen. We'll talk about some themes that traverse your entire market cap spaces. Have to talk about resources. By far and away the best performing sector in calendar year 2025. Off to a raging hot start again so far this year, up around 20%, whilst energy is also strong, up 14%. Marcus, large caps, resources. Talk to me.
You mentioned 20% there. Look, resources were up 14% in the month of February alone. So despite that very strong rally, we are still overweight resources overall. However, we have very specific commodity preferences within that. So unquestionably F26, it is the year of resources. When we look forward, we're talking about in aggregate earnings growth of about 23% for large cap resources. It's a broad church. Base metal prices continue to be strong. They're up circa 5% year to date, really driven by global growth and electrification. We're seeing iron ore prices be stronger than expected. They're hovering at just shy of $100 a tonne. Precious metals, we've discussed them earlier as well, but look, a lot of strength there. And I think gold, even if you hit pause at the end of February, is up 20% calendar year to date. And oil continues to grind higher, really encouraged, I guess, by the Middle East conflict at the moment, sending that further north. So for us, yeah, we have the commodity preferences. We favour commodities that are more supply constrained. Copper would continue to be a standout there. We like the higher quality end of oil and gas exposures where we can get that, where we're a little bit more cautious around iron or lithium owing to that supply constraint or lack of for those sectors. So notwithstanding resources now are trading at around 20% PE premiums relative to history, that's still not as amplified as the 30% premium across the overall market. And in fact, if we just hit pause and said, what happens if a lot of these commodity prices were to hold at these levels, we would see very substantial earnings and dividends upgrades in 27 and 28. Current consensus view is pretty much no earnings growth. Within the sector overall, BHP is a key name we still like. Strong result, 3% ahead at earnings, I think about 16% ahead at dividend. Copper result very strong. For the first time ever, copper is generating over half the EBITDA for BHP. On the iron ore front, they continue to really grind down their costs. They're about 20% lower than that large peer in the Pilbara. And Woodside on the oil and gas side, a key name. We like the quality of the assets. We like the 3 to 5 year production growth, particularly from Louisiana and Scarborough in Australia, and still trading at a very attractive valuation, double-digit free cash flow yield a couple of years out.
Marcus, I have to ask, like most retail investors, I look at charts quite a lot. I see BHP top right absolutely on fire just from a share price perspective. Doesn't worry you at all?
So I think it's pause to consider the why, and definitely it has amplified its multiple. The thing that's changed and the thing that we're testing ourselves on is the composition of earnings within BHP has also changed over time. So if we go back to now that point that over 50% of EBITDA is from copper, we can start to build a case that BHP ought to trade at better multiples relative to its past where it was predominantly iron ore.
Joel, let's talk about resources in micro caps. What are you liking?
Yeah, so it's really interesting. Like, I agree with Marcus on the macro side of things. Again, if you've got supply constraints and improving demand, that's always a pretty good place to be. And if you're either bringing a project in or you've got a long mine life and you're growing production, good costs, that's pretty attractive from a cash flow perspective at these kind of commodity prices. And I just think when you look at some of the changes that are occurring out there, there's some commodity intensity that people are looking at from a cyclical perspective, and maybe it's a little more structural than that. So again, to that point before, we've got lots of different ways of playing this. Metals X on the tin side has been a fantastic performer, generating a huge amount of cash flow, and again, a lot of optionality there. Lavoto, in terms of antimony, that looks really interesting to us. And then, you know, the different copper base metal plays in terms of lead zinc with stocks like Polymetals and Aurelia. Again, the business looks like it's in growth mode, good costs, they're investing, and we think that they're going to be generating some pretty substantial cash flows. And again, this is an area that's ripe for consolidation. You know, a game of scale, no one wants to be a single mine and have the risks associated with that. So we see another leg in terms of that M&A cycle as being very helpful to the resources sector. And I think a lot of professional investors, it's not a place they traditionally have been comfortable investing. I always like to think Australia's in the position we are, a lot due to our natural resources. And I think it looks like we're going through a period where it should be pretty helpful for investor returns.
Let's shift segments now, gents. We'll talk about the consumer space. So we saw some really interesting results and reactions. JB Hi-Fi was relatively good, I guess, in the context of the share price. Nick Scali, maybe not so good. Temple & Webster got absolutely hammered. Woolworths in the staples up 14%. You normally don't get that sort of excitement from a supermarket, but we saw it. Michael, talk to me about what's going on in the consumer space in the small caps.
In terms of the consumer discretionary space, it's no doubt been a difficult last couple of months. Stocks have underperformed, in part because of concerns around interest rates going up and demand slowing, and also weaker than expected results during reporting season. So in general, we've seen consumer discretionary companies have sales that are slowing, sales growth slowing in recent months, and also margin pressure. And the most noteworthy subsector where that pressure was evident was actually the auto sector, where we saw significant headwinds to earnings. In terms of how we're thinking about opportunities in this part of the market, you need to have companies that can grow market share on a sustainable basis, so you're not dependent just on short-term gyrations in the cycle. So they need to have a unique product where they can grow that market share. And two names we like in the consumer discretionary space are Guzman Gomez and also Baby Bunting. They have the additional advantage of being able to significantly increase their margins over time. They've both got store rollouts with really high incremental returns on capital and strong management teams supporting them as well. And because the sector has underperformed, you've seen those stocks underperform as well, and they're back to more attractive valuations, creating an attractive entry point for both names.
Burritos and babies, you can't go wrong, can you? Joel, I'll come back to you. Talk to me about consumer microcaps.
Yeah, so for us, Universal Stores really stood out. Again, it's looking at a lower demographic in terms of age, a lot more discretionary spending available, and that's something that, you know, they continue to perform really well. They got the right product at the right time, and people are prepared to pay a good price for what they offer, as opposed to trying to compete in these commodity markets and be on sale, you know, pretty much the whole year round. The other one that really stood out to us is Auto Sports Group. So again, selling cars, but in the more luxury end. This is a business, they own a lot of the property. They're continuing to acquire at low points in the cycle, and there's, you know, some really good new stock being released and things like that. And so we just think that that's a business where, you know, the margins are in the improve, the cross-sell between financing, parts and service is really strong, and something to us that looks like it's really turned a corner and looks pretty good value.
We'll bring it home by talking about the sector that we have to talk about, gents. Whether we want to or not, we actually have to talk about, because it's all anyone else is talking about. Tech and AI. Marcus, talk to me about what's going on. AI disruption, tech at the top end of the market.
I think for most of us, we've seen, haven't we, the big pullback in US software in recent times. In fact, that sector's off about 30% since the peak of last year. So what we saw on the ASX during the month of February is the tech sector pull back about another 9% for some of the same reasons. And while, Chris, we think AI will be transformative across the space, what really strikes us is how indiscriminate that downdraft has been. And I guess the frame of reference that we're bringing now is what could be overdone and where could there be opportunities. So the framework we're bringing around AI for tech companies is that trying to understand, is this a platform that will be a beneficiary or will be disrupted from AI advancement? How prepared is the technology for AI adoption, and how quickly could it actually be adopted? So that's the framework we're going through. What did surprise us as well is, as we think about some of the very substantial and very public cost reductions and job layoffs in some of the notable Australian tech-related companies. I mean, WiseTech, 2,000 people, 30% of headcount. I think Block spoke to 4,000 people, 40%. These are significant numbers. So to us, it's a bit of a shot across the bow in terms of what the potential productivity gains could be from AI advancement, but also the speed at which it's happening. So sitting back and moving forward across the tech space, We think NextDC is still likely to be a beneficiary in this environment. So we really like the demand that AI advancement is causing for their customers. We don't think that's a one-trick pony. That'll be a multi-year. We think the business is well positioned to sign ongoing more contracts, improve funding position, and the potential to almost double EBITDA over the next couple of years. So we think that's still a standout. More broadly, for companies outside of tech, from an AI perspective, we're really asking that question again: is this a business that actually gets stronger or weaker with AI advancement? One actual, probably an unlikely winner that we had the chance to meet with and understand a bit more during the result was Sims Metal. Now, Sims owns a business called SLS. It effectively looks to unlock value and repurpose older data centres. And the drivers of economic value there will be still around chip pricing and demand from hyperscalers. So we like the outlook for that business, and that'll be one to watch. On the flip side, where could there be risk? Business models that we're just quite wary of, where there's human information intermediary dynamics, they're the ones that could be at risk. So would call out there perhaps student placements, even white-collar engineering services and insurance broking.
Very interesting thoughts. Michael, bring us home. AI disruption in small caps.
AI disruption was a massive focus in small caps during reporting season. We saw indiscriminate selling across the sector, given those concerns around disruption. And our view is that's actually creating some buying opportunities. In terms of how we consider the risk around disruption, we consider a number of factors. With respect to technology companies, do they have a marketplace or a network effect? Do they have regulatory barriers to entry? Do they have unique data? And are they also ready to implement AI as well? Do they have a technology stack that supports it? The other factor, though, of AI is actually the productivity side, which Marcus spoke to as well. We saw some interesting data points around material improvements in productivity, with large reductions in employee numbers. Our view is at the minimum you're going to see improved productivity going forward, and businesses will be able to scale more efficiently in the technology market. What was interesting was the market, though, was very focused on the disruption side of the equation and saw companies materially underperform. And our view is you're not seeing value placed on companies that can execute on the productivity opportunity. So that's an opportunity going forward. If we think about companies that could benefit on both sides of that equation, our view is companies like NetWealth and also Cascale are well placed to see productivity improve and not be disrupted as well. The other notable change with so much changing on AI around both disruption and productivity, the demand outlook for the picks and shovels would seem to have increased materially during reporting season. So that's a notable positive for companies like Megaport that will benefit from that improving demand outlook.
Michael, Joel, Marcus, it's always a pleasure. Thank you for taking us through what was a hot reporting season. Well done, thanks. If you enjoyed that conversation, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.